Welcome to the ICAEW Insights Podcast.
Hello and welcome to the ICAEW Insights Podcast, where we analyse the latest news from the world of accountancy, business and finance. I'm your host Tom Herbert, and on today's show we hear from the new Small Business Commissioner on the vital role accountants play in getting businesses paid promptly. We examine the government's basis period reforms and how they interact with making tax digital for income tax proposals. We hear from a chartered accountant whose football finance podcast recently hit 3 million downloads. And we ask, why does the IAASB think we need a standard for less complex entities? We start with the UK government's attempts to tackle the scourge of late payments. An estimated £23 billion is owed in outstanding invoices to UK businesses at any one time, and small businesses often bear the brunt of poor payment practices from their larger counterparts. As a range of measures to get to grips with this, the government has recently appointed Small Business and Consumer Affairs broadcaster Liz Barclay to the role of Small Business Commissioner, and I'm delighted to welcome her to the show. Hi, Liz.
And I'm delighted to be invited, Tom. Thank you.
So, firstly, can you tell us a bit about the Office of the Small Business Commissioner and your role in it?
Yes, the Small Business Commissioner was set up as part of the Enterprise Act in 2016, and the office opened in December 2017. And our role really is to try to get small businesses paid on time and paid better, I suppose you could say. Because although we talk about late payments, I think late payments tends to cover a whole range of problems with payments. So it might be late, it might be an overdue invoice that was due at the end of July and is still outstanding in August, but it might be that a small business has taken on a piece of work and agreed to be paid in, let's say, 60 days, 90 days, 120 days. I've even seen 180 days hence. Now, that to me is quite a long time, 6 months waiting to be paid. And we do need to change the culture of that if at all possible.
How much of a problem are late payments for small businesses? And has the pandemic exacerbated this or helped it in any way?
Anecdotally, we think that it has helped in that there have been a lot of big businesses that have understood that they could be losing suppliers if they don't pay their small businesses throughout this pandemic. And so they've made efforts, real efforts, to pay much more quickly than they have in the past. And we've heard about small businesses being paid in 7 days, for instance, or big firms committing to pay in 0 days, which is very, very difficult, it has to be said. Usually you will get paid the next day at the very, very soonest. So we have seen some really good practice, and we'd love to call that out and use that, share that good practice with other companies. But on the other hand, we definitely have heard of cases where the pandemic itself has led to an increase in late payments because, of course, there are businesses out there themselves waiting to be paid so that they can pay their small suppliers. And so it's been a bit of a mixed picture. Certainly, figures from the Federation of Small Business fairly recently have showed that 62% of all small businesses have experienced either an increase in late payments or had payments frozen completely as a result of COVID, and that 10% of small businesses have experienced longer payment terms from customers as a result of COVID. So it is a mixed picture. Some people have really pushed the boat out and got better, and in some cases small businesses are waiting longer.
And could you just tell us a little bit about the Prompt Payment Code?
Yes, the Prompt Payment Code is a voluntary code. The code itself is owned by the Department of Business, Energy and Industrial Strategy. We administer it at the Office of the Small Business Commissioner. So we sign up the signatories to the code, and we work with companies that would like to join the code in order to get them to the point where they are meeting the commitments of the code. And a signatory to the code is committing to paying their small businesses, 95% of their small businesses, within that 30 days. And so it is a real commitment because it's voluntary. nobody is forcing companies to pay up, but what we are finding is that companies are beginning to realise the value to their reputation of being signed up to the code. People want to work for and invest in ethical businesses, and this is one way of showing that you are an ethical business and that you really care about doing the right thing and care about paying your small businesses on time. So we have about 3,300 businesses signed up to the code, and we're hoping to sign up more.
Recently, there's been news that several multinationals could face suspension from the Prompt Payment Code for failing to honour their commitments to pay suppliers. Are there plans in place to look at introducing a stricter regime than the one you've just outlined?
No, not at the moment. The reforms came in at the beginning of July to make firms pay more or commit more to paying their small businesses within 30 days. And so that is the most recent reform, and that's the only reform at the moment. But we will work with firms in order to try to, as I say, get them onto the code or keep them on the code once they have signed up to it, if at all possible, because it is to the benefit of small businesses if we can make sure that firms are signed up to the code. So therefore, we will work with them. We will do our best to make it possible for them to meet the requirements of the code. And we will continue to go on adding signatories as and when businesses apply to us. It is free to join, I should say. So it's not that businesses should be worried about how much it's going to cost them. And we will do our best to help them to meet the requirements of the code for the benefit of the small businesses that we are there to protect.
And you recently wrote a piece for us on ICAEW Insights around the role that accountants can play to help small businesses get paid more promptly. Can you just give us a quick précis of that, please?
Well, I couldn't possibly come on the podcast and not say that accountants have a really important role to play. I think there are a lot of small businesses that assume that it's really expensive to have an accountant. But accountants are a great source of information on all aspects of finance for your business. And so one thing I would say, though, is to find an accountant who's used to dealing with small businesses, not just big businesses. And also, probably it's better if you can possibly find an accountant who understands your industry. Yeah, I've had an accountant for several years as a freelance worker, and he works with people from the media. And so he understands very well the working conditions, and I think that really, really helps. But certainly accountants can be extremely well worth the fees that they charge, but do make sure, as with everything else, that you know what they're going to charge before you sign up a contract with an accountant or any other advisor.
Thank you very much for joining us, Liz. There's a link to Liz's article on ICAEW Insights in the podcast show notes, along with a link to contact the Office of the Small Business Commissioner. Thank you very much for joining us, Liz.
Thank you for having me.
Now, the summer months are traditionally seen as a quiet period in the accounting calendar, but this year the government has used this time to table some of the most radical proposals to reform the tax system that we've seen in a generation. Lindsay Wicks, technical editor at ICAEW Tax Faculty, is here to tell us all about it. Hi, Lindsay.
Hi, Tom. Thanks for inviting me back.
It's a pleasure. So let's start with basis period reform. So the government is consulting on its intention to reform basis period rules so that trading profits are taxed in the tax year in which they arise, and implications of the proposed reform, in particular the interaction with MTD for income tax self-assessment, are slowly emerging. It might seem simplistic, but can we start by defining what a basis period is?
At the moment, the general rule for a trading business subject to income tax is that the basis period for a tax year is the period of 12 months ending with the accounting date in that tax year. So, for example, a self-employed person with an accounting date of 31st December, their taxable profits for the 2021 tax year would be based on their profits for their accounting year ended 31st December 2020. There are special rules to determine the basis period in the early years of trading, perhaps because there isn't an accounting period that ends in the tax year, or the period is less than 12 months. There's also special rules when there's change in accounting dates. These rules can give rise to profits being taxed in more than one tax year, generating overlap profits. And these overlap profits generally unwind when a business ceases.
So what is the government consulting on?
So the government wants to simplify the income tax rules for trading profits before it introduces Making Tax Digital for income tax self-assessment. It wants to move away from a basis period system to taxing profits arising in a tax year, regardless of the accounting date. It proposes that this tax year basis would start in the 2023-24 tax year, with a transitional year in 2022-23. During the transitional year, relief will be given for any overlap profits, and the government's also considering an election to spread any additional profits arising as a result of the transition. Another small change it's looking at making is a deeming provision for businesses with accounting dates that are close to the 5th of April tax year end. So, for example, a 31st of March date, and this will prevent small apportionments of profits between the tax years where the accounting date is so close to the end of the tax year.
It's obviously a major proposal, and it's generated quite a lot of comment in the accountancy news and in the wider business sphere. What issues have been raised around this?
So the primary issue is for businesses that don't draw up their accounts on a tax year basis. For commercial reasons, they can't change their accounting date. So they'll have to draw up their accounts and apportion their profits from those accounts between tax years. In many cases, this could add a bit of estimation into the tax system, particularly where their accounting date is later in the tax year, because they might not have finalised their accounts in time to submit their tax returns. So examples of businesses who choose to have a different accounting date could be an arable farming business. Traditionally, they quite often choose the 30th of September as their accounting date, so after the main harvest has been collected in. International businesses quite often have calendar year-end dates to tie into tax reporting elsewhere. It had been anticipated that the introduction of Making Tax Digital for ITSA would be staggered based on a business's accounting date. Aside from whether the systems will be ready to cope with everyone going at the same time, there'll also be bunching of workloads that could put strain on agents, businesses and HMRC. There's also other knock-on effects that are emerging, so more complex capital allowance calculations for those with an accounting period that differs from the tax year, calculating pension relief, the impact that estimation could have on high-income child benefit charge calculations, because you have to decide which of a couple has the highest income. If that's not certain, the liability could change as things emerge. That's going to be complicated. You could have a truncated window for making claims in an election where finalising a tax year is delayed. Transitional profits could mean that profits are taxed in a higher tax band than they might have otherwise been. And if there is an excess profit in the transitional year, there's interaction with other things in the tax system that are based on the measure of a person's income. I've already mentioned the high income child benefit charge, marriage allowance claims and student loan repayments. So there's a lot of things that could have a knock-on effect from this change.
Off the back of this, ICAW has joined other finance and tax professional bodies in writing to Jessie Norman, the Financial Secretary of the Treasury, warning that the proposed timetable for reforming basis periods will place enormous pressure on businesses, advisors and HMRC and risks undermining trust in the UK tax system. So what's been asked for and why?
In a nutshell, the bodies have asked for the proposed timetable for both basis period reform and Making Tax Digital for income tax self-assessment to be reconsidered. These are fundamental changes to the tax system, and it will mean an increasing number of businesses will be asking for support from agents and HMRC. The profession's keen to ensure that trust is maintained in the tax system and that the integrity of the tax system is not put at risk from these changes.
And also, HMRC has confirmed that the UK will be adopting the expanded version of the OECD reporting rules for digital platforms, meaning that websites and apps will have to report the incomes of sellers of goods as well as personal services, potentially from January 2023. Can you tell us what's in the government's consultation and why it's important?
Well, first of all, it's important for businesses and advisors to be aware the information about what they're selling on these websites are going to be shared with HMRC and internationally with other tax authorities. As tax becomes increasingly digitalised, that information could form part of pre-population of tax returns, for example. So the consultation itself is fairly limited because it's based on an already agreed set of OECD model rules. The government's just consulting on the optional elements, such as which platform operators can be excluded from the reporting requirements and the practical implementation of the proposals. Now, one interesting aspect is how this potentially ties in with the issues raised in considering the tax year end date and also basis period reform. As this is an internationally agreed measure, the reports will be made on a calendar basis, so to the 31st December, and they've got to be provided to the tax authority and the seller by the 31st of January following the end of the year. Now, HMRC's identified in the consultation document that this obviously causes an issue for sellers with an accounting date of 31st of March. So the report covering the first 9 months of the period should be available to the seller a year before their current self-assessment deadline. However, the report covering the final 3 months won't be available until the date of the self-assessment deadline, so too late to be of any assistance to the taxpayer.
Thank you, Lindsay. Goodness, a lot covered there. A busy time for those interested in reform of the tax system. All links to tax faculty stories outlined by Lindsay can be found on ICAW Insights and in the show notes to this podcast. Moving on to football now, where the new league season is now in full swing. Anyone with a passing interest in both football and finance is likely to have heard the Price of Football podcast, where University of Liverpool football finance lecturer Kieran Maguire and comedian Kevin Day follow the money behind the world's most popular game. Started back in 2019, the podcast is now closing in on 3 million downloads, and I'm delighted to welcome co-host and chartered accountant Kieran Maguire to the show. So Kieran, a fairly simple one to start with then. What drove you to start the podcast?
Well, at the University of Liverpool, they've always encouraged me to do what's referred to as loosely public engagement, i.e. to speak to newspapers, radio shows and television in respect of football finance. And there was a slight degree of frustration in that I could only really dip my toe in the water in terms of what could be covered, because a producer will say, you've got 2 minutes, keep it tight. The good thing about podcasts is that they are open-ended. There's nobody shouting at you as to what you can and cannot say. There's no definitive time. So I was approached by Guy Kilty, who I got to know because he was one of the presenters on Five Lives Wake Up to Money. And he was thinking of setting up a podcast production company because he felt that there was a gap in the market and wanted I'm a bit loath to say flagship show, but he wanted an initial show to play with. We had a discussion. I said I didn't think it would work with just myself presenting it because it would come across as too-stayed. I'm a big fan of Kevin because I remember him giving a benefit gig for my football club when we were in danger of going out of business, and I always appreciated his efforts. So I pitched to him on Twitter, and he was very tolerant because I could hear the cogs going through his head. Who is this strange bloke wanting a podcast on football finance? It will die within a fortnight. Nobody will listen to it, and I'll just pretend it never took place. But at least he was prepared to say hello and to get it started. And we sort of hit the ground running because at the time Bury Football Club was being destroyed, and we had a list of topics which came up. So our initial aim was for one show, which we thought might last for 20 minutes. And I must confess, I thought we'd run out of topics after 3 shows, but we've now just completed edition number 181, featuring the former Sports Minister Tracy Crouch, who's just done the fan-led review of football. And we're twice weekly. The show normally somewhere between 45 minutes and an hour, because there's just been so much to talk about in what is a fairly niche area.
So, as I mentioned earlier, the podcast is now closing in on 3 million downloads. Why do you think the podcast has proved so popular with fans?
I think it's because it straddles quite a few areas. Somebody described it to me as a football finance show for people that have got no interest in football or finance. And this actually came from a person. I've got a fantastic working relationship with Kevin, and I think he is the man in the pub asking the questions. I play the role of the useful idiot on the show, sort of, dealing with issues from a financial or accounting or technical perspective. But I think it's Kevin's ability to he interjects, and he is very, very funny comedian. He writes the hosts' scrolls for Have I Got News for You and A League of Their Own and shows like that. So he puts me at ease, because I was very nervous the first time I did it. And I think we are seen as being fair-minded. So there is no agenda as such. It doesn't matter whether you support Chelsea or Carlisle or Manchester United or Morecambe. We feel that every club's fans have an equal importance. We understand that we are listened to in the boardrooms and in the vast majority of clubs in English football, and some Scottish clubs as well, partly due to the fact is that they don't want their club to appear on the show, because, as with all news, there tends to be more bad news stories than good ones. And we've got a very loyal listenership who hold us to account as well. If I get something wrong, I will be told in no uncertain terms. Football, it can still be a romantic game within the confines of being a multi-million-pound game at the same time.
And I guess as well, information is power, and your average fan on the street might not be able to, or well, they can go to company's house and pull off a set of accounts, but they might not be able to interpret them in quite as much depth or detail as you can, because of your accountancy background. You know what you're looking for.
Yeah, I'm quite obsessive about Companies House, and I can't remember which government minister was responsible from changing it from when you had to go and pay £1 for each download to making it free. But my hat is permanently doffed in that minister's direction. I've got every single set of accounts of the Premier League since it started in 1992-93. I've got a spreadsheet which has got 215 individual worksheets, devoted to individual clubs in England and Scotland. And it's my job as a teacher to make things which people, in the context of students, which they might initially find complex, to simplify them and to disaggregate them and to be able to deal with them in bite-sized chunks. And that's what we try to do on the show. Kevin and I, we talk about the mum test. Could we explain this to my mum or Kevin's dad, who come from a different generation, aren't financially familiar with a lot of the terminology, and we've always got that at the back of the minds. At the same time, we know people from the accounting and finance profession will be listening in as well, and the aim is to make it as universally understandable as we can.
So on a broader basis, the new football season has just kicked off. Fans are back in the stadium. Can you give us a brief update on how the pandemic has affected the finances of football clubs?
Well, football clubs generate revenue from three broad sources, the biggest of which is, in the main, the broadcasting rights. And that's why there was so much effort under Project Restart for the Premier League to recommence when it was interrupted as a result of the lockdown for the 2019-20 season, because that reduced the amount of rebate that the Premier League had to give to its broadcasting partners. So the broadcasting rights have held up, but there have been some rebates. I think we've been quite lucky here in the UK compared to countries such as France, where the TV deal was effectively ripped up, and we've seen new deals in the Bundesliga and Italy, which have at a discount on their original agreed fees. So that's one positive. The biggest hit as far as the game is concerned has been in respect of ticket sales. And in the Premier League, about £1 in every 7 comes through the turnstiles. But even so, in a good season in the Premier League, we are talking around about £700 million spread between the 20 clubs. So that's been a hit for over a season. And then the third arm is commercial partners. And I think the view that they took was, whilst matches were being broadcast, then our brand was still getting into people's eyes and ears. So there's not been too much of an issue in terms of the commercial relationship and sponsorship relationship at the top tier of English football. But when you drop out of the Premier League and you go into lower league football, they become far more reliant upon matchday ticket sales, and also the sponsors tend to be local in nature, and that means they have been cancelling some of their commercial arrangements because they don't get seen on television, and if a match is taking place in front of an empty stadium, then nobody's getting to see their brands. So coronavirus has hit the lower tiers of football significantly, but a combination of the furlough scheme, grants and loans from the Premier League to lower tier football, and owner contributions have allowed the game to, fingers crossed, to have not had any casualties, with the exception of Macclesfield Town, and their demise, sadly, was again due to owner issues rather than it could be levelled at the pandemic.
Well, Kieran, I'm afraid we're out of time, but thank you so much for joining us today. You can hear more from Kieran at a special ICAW event, An Evening with Kieran Maguire, on the 16th of September at the Amex Stadium in Brighton. More details on this and the Price of Football podcast, go to ICAW Insights or visit the show notes to this podcast. When it comes to international standards on auditing, increasingly complex structures and transactions obviously need to be addressed. However, with smaller entities accounting for the vast majority of organisations around the world, increasing complexity can pose challenges for audits of less complex entities. Based on the feedback from a discussion paper, independent standard setting body the IAASB has developed a draft standard to address these issues and provide what it sees as a global solution. To take us through this, I'm joined by Catherine Bagshaw, Manager Auditing Standards at ICAW. So, Catherine, why does the IAASB think we need a standard for less complex entities?
Well, Tom, for some of our members, this is a no-brainer. Auditing standards have grown exponentially in the last 30 years, and there's a long-standing and deeply held belief among many that the current auditing standards are just far too long and complex now for smaller audits. Back in 2016, the Nordic Federation of Accountants issued a draft standard for the audit of smaller entities, and it generated a huge amount of interest globally. And since then, IAASB has developed a number of discussion papers and consultation papers looking at the subject with a view to developing an exposure draft. And of course, many listeners will note that an exposure draft has just been issued back in July this year, in the face of some opposition, I should say, with a comment deadline of 31st of January next year. And that's a huge achievement for the international standard setter. IAASB should be congratulated on that. And ICAW has been right behind this project. We've been enthusiastic supporters right from the start.
You mentioned some of the issues that have prompted this to happen, but are you able to sort of expand on a few of the issues?
Well, yes, the reality is that the Nordic Federation standard prompted a number of other jurisdictions to develop their own standards for auditing smaller entities. So we now have standards in places like France, Germany, Belgium and Switzerland. We've also got them in India and Sri Lanka, and they adopted the draft that the Nordic Federation developed. And there's probably a number of other jurisdictions that we don't know about. And there's a very real risk here that the remarkable consensus on auditing standards that's been built up globally over the last 30 or 40 years will be lost if this fragmentation continues. And it's in no one's interests that every country has a different standard for auditing smaller entities, or no standard at all. And that's a big issue where you have high audit exemption levels, as we do in the UK.
I mentioned earlier that the smaller entities account for the vast majority of organisations around the world. Obviously, with this draft standard, as it were, this will affect a number of companies. Do we know how many companies could be affected?
Well, the proposed standard applies to less complex entities, and that's not the same thing as smaller entities. And the reason for that is because an international standard setter can't put size criteria on this, because a small company in Europe could be a bigger company in some countries in sub-Saharan Africa. But of course, in reality, there is a lot of overlap. A lot of smaller entities are less complex. So what we think will happen and what we expect to happen is that any jurisdiction that adopts this standard will apply certain size criteria in addition to the complexity criteria, which are much more subjective and vague. And that's given rise to a lot of the opposition. But if you overlay size criteria, as you do for the use of FRS 102 in the UK, for example, and there are parallels in every other jurisdiction, it makes it much easier to deal with, reduces the scope for conflict between practitioners and the people who regulate them. Now, one of the basic requirements is that the entity mustn't be a listed or public interest entity. Now, that's far from the only requirement. There is a huge table of issues that relate to complexity that would preclude using this standard. Having complex accounting estimates, for example, or having a complex business structure or a complex governance structure or anything else that is going to make this a bit difficult. But if you just take that first, in the UK, the vast majority of companies aren't listed or public interest entities. And that's true in most of the rest of the world as well. But we think it's unlikely, certainly in the first instance, that all of those entities would be covered by the new standard, even though potentially they could be. It's because we really are in completely uncharted territory here. This has never been done before, and it makes regulators in particular really quite nervous. So we all need to proceed with a bit of caution to make sure that the standard of work is maintained.
So in terms of taking the draft standard forward, what happens from here?
A comment deadline of the 31st of January next year might seem a way away while a lot of people are still on holiday as we record this in August, Tom, but that time will go pretty quickly. And we're hoping to develop an initial draft response early in the third quarter of this year. We've pulled in the training providers, the methodology providers, the software providers, and other people who've got a real interest in the technical detail on this. But we do need the views of members on those technical details, particularly on areas such as internal controls. Internal controls has been a big issue in smaller audits for many years. There are lots of practitioners who think you really shouldn't have to do much, if any, work on internal controls if you're taking a substantive only approach, for example. But the draft standard as it stands does cover a certain amount of work on internal controls. It's not exactly the same as it is in the full standards. There are changes, and we really want practitioners' views on how much work that's going to involve and whether that's going to be useful work of value to the audit. Because that's a principal complaint at the moment, that the work, some of that work or a lot of that work doesn't really have value to the audit. Another big issue is group audits. There are three options in the draft standard. Either you exclude group audits altogether, or you only include groups where there's a single auditor, or you cover all groups. Now, IAASB is suggesting you exclude them because it keeps the standard short. We don't think at the moment that that's right because it excludes too many companies. We want members' input on that, of course, as well as the bigger picture issues. We've got a good working group headed up by Catherine Wilshire of Price Bailey and Neil Lawrenson of Mazar. We'll be consulting right across ICAEW as always, but with this project we'll also be holding a live face-to-face event in Chartered Accountants Hall in November, regulations permitting of course, and the keynote speaker will be Tom Seidenstein, and he is the chair of the International Auditing Standards Board. And interestingly, he was involved with the International Accounting Standards Board when they developed the IFRS for SMEs. So he's got an interest in this. And that event will be, of course, live streamed as well. We're hoping to talk to HMRC, credit referencing agencies, banks, lenders, and any other stakeholders who are going to be affected by this. But we really do need to hear from members, especially about the technical detail. I'm the key contact, Tom. My email address is on ICAEW's website, and we'd be delighted to hear from you, and sooner rather than later as well.
Thank you, Catherine. Fascinating stuff, and one which ICAEW Insights, I'm sure, will return to before too long. And that's all we have time for today. My thanks to all our guests, Lindsay Wicks, Kieran Maguire, Liz Barkley and Catherine Bagshaw. Thank you very much for listening, and we hope you'll tune in next time. Bye for now.
We hope you enjoyed this episode. If you want to hear more from ICAEW, subscribe on Apple Podcasts, Spotify, or wherever you get your podcasts.